Retail sales unexpectedly fell in February, dropping 0.2%, the latest indication of hesitation among consumers. But retail sales for January were revised higher to a 0.7% increase from an earlier reading of 0.2%. Joining us is Eventshares CIO Ben Phillips. Ben, your read on the numbers we got today.
Well, AIkiko, I think we've seen this weaker retail sales trend over the past really 10 years post-recession, where Q1 has a lot of noise in it. So we caution investors to read too much into these monthly numbers generally, but particularly retail sales in Q1, they tend to always be choppy and volatile.
What's driving the weakness, though?
Well, I think there's a couple of things longer term where we're looking at some secular changes. Like over the past 30 years, we haven't seen really wage growth on an inflation adjusted basis, right? You've probably talked about those stats a lot on this show, how the average consumer is not really in a better position despite all the economic growth we've had in 30 years. And then the other thing is I think there's a lot of choices for consumers. So now we have lots of different services. We have these streaming services we're just talking about, right? We have Netflix and Amazon. We have Spotify. We have other areas where there's consumption of the consumer's wallet share. And so I think it's partially no wage growth and a lot of other options for consumers. So the traditional retail sales channel and industry is a little different these days.
And so for investors who are looking into the retail space, without going into any specific names, where is the big bet right now? Is it on the e-commerce side of things? Is it some of the brick and mortar stores? Where do you think they should be looking?
Well, I think it is e-commerce. I mean, obviously, that's a big trend. We play it in our policy portfolio a little differently, right? We're looking for policy catalysts. So we have like a sales tax compliance name in there, Avalara, AVLR. They're a smaller company, but they are about to grow very quickly, we think, given that these e-commerce companies have, a need to pay sales taxes or have their consumers pay sales tax at the point of transaction. So we're kind of looking at different areas of this, but I think you're right, like e-commerce, obviously a big growth area. But again, we're playing it from the policy perspective a little differently.
Let's talk about the broader market. There's certainly been questions around central bank policy, although it does seem like now that we've seen the Fed step back a bit, the ECB take a more easing stance, that could certainly provide tailwind, at least in the near term. What's your outlook?
Yeah, we've actually turned a little more constructive recently, and it's partially because of the Fed's 180 effectively back earlier this year. And also we're seeing some constructive signs of the China-U.S. trade talks. So, the U.S. and China are finally talking about the real issues, this, intellectual property theft, with certain just rules and admitting that there was actually some issues there was the first step that we've seen China actually say there was an issue. And so we're getting more constructive, given we've heard some positive things coming out of those talks. We think if that actually gets done in the next month or two, which is our base case, that's a big boon for U.S. risk assets and stocks.
But in terms of, the deal itself, how much of the specifics actually matter? Because you talk about IP theft, that's one, but the enforcement element certainly doesn't seem to be nailed down by any means on either side.
Yeah, that's probably the final sticking point, and it's going to be a very important point. But the fact that China is actually acknowledging that there are IP protection issues, there are cyber theft issues in their economy, and I think that tells you right there that they've already kind of moved towards the U.S.'s side a little bit. There was a big issue back in July when these talks were stalled, that China wasn't even admitting there was an issue there. So the fact that they're talking about these issues shows you that China realizes that this is really the starting point for the U.S. talks to really move forward, and so that's why we got a little more constructive.
And Ben, going back into the equity space, we've been tracking Lyft's IPO since Friday, prices below that $72 a share, a price that they listed at. What do you see as behind the dip here? You think investors maybe got a bit ahead of themselves in terms of the pricing and seeing the potential in the market? And I wonder what you make of the slide that we're seeing today and the implication for some of the other companies that could follow.
Well, this is pretty common of these tech unicorns, and we've been really cautious on just even telling investors that they should consider them seriously. You have a lot of two things going. So you have one, insider selling is a big thing after these IPOs, where you have a lot of insiders who finally can monetize some of that wealth they've created by being long-term employees. So you see that pressure. That's a natural selling base. The other side is you have the venture capital as well on there, who is a natural selling shareholder over time. So you have some partners there and others. So there's just a natural selling that occurs after this. The third is these companies don't really make money, and the path to profitability is a concern for a lot of institutional investors and others. So people who are looking to make a quick flip, it's not doing well, they're probably selling today too.
It all goes back to the profitability question. All right, Ben, good to have you on today. Ben Phillips there joining us from Eventshares.
Thank you.